Good morning, everybody. My name is Lance Gunkel. I am the Managing Director of Syverson Strege. I am joined on the call by several of my colleagues, including Jason Gunkel. He is our Chief Investment Officer, and Matt Roberts. He is our Chief Planning Officer. They'll help me be fielding calls as we go along this afternoon. The agenda for the call today, I'll be going through some introductory remarks, commenting on where we're at, and just providing some practical advice for you. And then we'll go right into questions. The way we'll work questions is that we'll use the chat feature. So if you look to the far right of your screen, you'll see an area that says Zoom group chat. If you will please change the "to" my name, Lance Gunkel, and direct your questions directly to me. I'll be filtering through those throughout the call and posing those questions to the right person to help answer those. So again, on the right-hand side of your screen, under group chat, under the "to", please use my name, Lance Gunkel, and type in your question to me, and we'll go through those. So thank you for taking the time today to join us. I imagine you might be stuck at home, and this was simply something to do to fill the time, but happy to fill that time for you. I know my whole family's here, and we're trying to find things. I have two boys. We're trying to find things for them to do. On the pro side, we've started a family book club, which is off to a good start. But my boys have also started a prank war. So I've told them that for this hour, the prank war is off limits. I'm not sure if they'll abide by that or not. So just in case they decide to get a little crazy, I am going to turn off my screen. Well, to start, I'd say it should go without saying that most importantly for us is the health of our clients as well as that of our employees. That's why we made the decision on Monday to close down our office through the end of the month. And since things are changing so rapidly, we'll make a decision down the road if we need to stay closed for longer. But I will tell you that we continue to be available to you. You can call our main phone line at 515-225-6000, speak to anyone on your team. You can also email us directly to help answer any questions that you have. I know that there's likely a lot of anxiety in the room. Whenever we're faced with situations that are unfamiliar or uncomfortable for us, anxiety is natural to feel. And I will remind you that it is exactly for situations like this that you've hired us to help put a plan into place. It's for those unexpected situations. It's the reason why we recommend having an emergency cash reserve. It's also why we recommend having at least 12 months worth of spending needs in cash or short-term bonds. And as you've worked with your team to develop an asset allocation for your investment portfolio, it's why you should have approximately 3 to 5 years worth of spending needs in bonds, because bonds provide some stability during times like these. So remember that from a financial standpoint, we should have you covered. We should have you able to weather situations like this. Now, our team has talked for several years about the possibility of a market downturn. Stocks and other assets were, in our opinion, priced expensively and suspected that something would cause them to fall. We've had that catalyst now. We didn't know it was going to be this. We knew it would be something. So now we've seen that decline. I'll change slides here. Oop. So this chart shows that we've just wrapped up what was the best bull market in history. This chart shows the returns of the S&P 500, which is an index of US stocks. And from March of 2009 up until this last month, we saw a return in excess of 472%. So it was a good run while it lasted. Some other statistics to share with you. This is return data at the end of 2019. You see, 2019 was a fantastic year across the board, really. The US stock market was up 31%. The international stock market was up 22%. Bonds did quite well also. Now, since that time, it hasn't been so rosy, as you know. I'll give you some return data for this year. Now, this is changing day by day. So I realize some of this will be out of date. The numbers will change. These figures are as of March 12th. You can see the US market was down about 24%. The international market was down about 27%. In fact, on Monday, the S&P 500 dropped 12%. That was the third worst single day since 1928. I think some more up-to-date figures indicate that the US stock market is down about 30% on the year. Oil has also fallen in price. It fell 11% on Monday. It's down about 55% on the year, and it's at $30 per barrel. Now, this drop may continue for some time, and this volatility in the markets is driven by fear and the unknown surrounding when the virus may be contained, how bad it could get, and how sustained it will be. Globally, economies around the world were looking like they were heading into a slow growth period. And with this virus, it's almost certain that we'll experience a global recession. So, I think it's maybe beneficial to look at why that's the case. It's helpful to look at this virus occurring in so far 3 different chapters. So the first chapter begins in China, early January of this year. That's where the virus broke out. And as a result of the virus spreading throughout China, many factories had to shut down. So as a result, companies across the globe were unable to get the supplies they needed for their products. Apple was one. We knew that this would slow down the availability of Apple products. Pretty quickly, Nissan and Hyundai also had to shut down their auto factories. But at the time, I think the feeling by and large was that, yes, this will slow down supply of certain types of products, but eventually that'll work itself out. And if we have to wait a few months for a car to be delivered, that's okay. Then we had chapter 2, which started in February of this year. Chapter 2 is where Italy had a severe spread of the virus. They continue to experience that and work on stopping the spread of the virus in Italy, and it hit the rest of Europe as well. As a result, many more areas of manufacturing and production had to shut down. And this is where it became evident that things were getting more serious. Then we have chapter 3, when the virus first made its appearance in the US, March of this year. And since then, it seems like it's been a situation in flux daily. So the Fed tried to step in and stop the economic downturn as best as possible through rate cuts. But the market reacted viciously regardless. And that's because this isn't or will not be a typical type of economic downturn. This isn't a matter of companies needing cheaper money to be induced to provide more products. On the supply side, we see that factories are shut down and unable to produce goods. The service industry is, for all intents and purposes, shut down. They're not able to create the services that people may want to buy. On the demand side, consumers may very well want to spend, but they're unable to do so because they're mostly confined to their homes. So we see issues on both the supply and the demand side. The way to get the economy moving again is to first stop the spread of the virus. So we know that the short-term impact is going to be probably a severe hurt on economic activity. Everything is shut down. But we know that doing this, the hope is that it will save lives, it will stop or slow the spread. Businesses can reopen, people can go back to spending money, and we will eventually have that recovery. So what can help? I see that the presidential administration is now looking at a relief package that would include $300 billion to small businesses. That would help them meet payroll demands, help them meet their rent or lease demands. And also the potential for money going to individuals. Looks like the most current thing I read is that it would be an immediate check of $1,000 to each person and then a further $1,000 down the road. So that hasn't been passed yet, but that's being talked about. I do think that would help keep businesses afloat, and it would help households be able to cover expenses since overall payrolls will certainly be down. So as an investor, what are some things that you can be doing? And what can we be doing on your behalf? First is you can harvest some tax losses. So this is a process where we would work, we're doing this on currently this week for you, but it involves looking at each one of your positions and seeing what is at a loss. We're capturing that loss so that you can put it on your tax return and use it to offset future gains. But since we don't want you to be out of the market, since we don't know when a recovery will occur, we will invest in a similar security that's in the same asset class. So you remain fully invested, but you're able to take tax advantage of this situation. Again, that's something we're doing on your behalf this week. Next would be rebalancing your portfolio allocation to the target weights. When you met with your team, you initially set an allocation for each one of your accounts. So a certain amount to stocks, a certain amount to bonds. But as we see the market fall like it has, you will now be underweight to the stock portion of your account. So what we do on a quarterly basis is rebalance back to that target allocation. So when we do that for you, you are buying into stocks at a now lower price. It helps you sell assets that are higher in price and buy assets that are lower in price. Next, I would suggest not letting emotions get in the way of your long-term investment plan. It's understandable to get emotional about what's going on in the markets, but sometimes emotions can be your worst enemy. So my slides are going a little bit crazy here. I apologize for that. Up on the screen now shows how reacting and missing out on a possible recovery can harm you and your overall performance. This is a chart of the S&P 500 index, so that's US stocks, and it's from October of 1989 through December of 2016. So the chart's a little dated, but the message still rings very true. During that period, $1,000 invested in the S&P 500 grew to about $11,500. If you missed the best day, instead of 11,500, you would have 10,300. So from a return standpoint, you went from having a 9.38% average annual return to an 8.9% average annual return. And then you can look at missing those 5 best days, your return drops further, and it starts to get pretty substantial. We don't know when a recovery will occur, but we do know that one will happen. And since we can't time it, we don't want to even try. We want to keep you invested and avoid the emotions of trying to cash out at the wrong time. Rebounds tend to occur very quickly, and we want you to participate with that. So with that, I will open up for questions. We'll give you time to write your questions in. Again, please use the group chat feature on the right-hand side of your screen. And under the "To," you can use the drop-down menu and select my name, Lance Gunkel. Type your message, and we'll get those queued up. I think while we wait for some questions to roll in, Jason Gunkel is on the line. Jason is our Chief Investment Officer, and I know he's been fielding some calls from his clients. Jason, I'm wondering if maybe you have any words of wisdom you can pass along to the group.
Sure, you bet. I just got my dogs out of the room here, so hopefully they don't, you don't hear them barking. But I think what you said already is very applicable and is great advice. I think, fortunately, we have great clients who, I think the majority of questions that we've received so far, the calls that I've taken, have not been calls that are panicking, but more about when to put money in and some general advice of when to put more money into the stock market. And I think what I can say about that is if there is cash on the sidelines right now that you are holding, it does make sense to start putting some money into the stock market now. And while it's definitely possible that over the next few months we see some larger market drops, we've seen the market now drop about 30%. So it is a significant discount to where the market was trading at the end of the year. And it's certainly prudent to start buying stocks now. We have just been setting up a program with many clients to invest that money over a period maybe of 6 months. And that way, if we do see some bigger market drops, then we can put more money in. And the other thing I'll say is with our portfolios, we have been a little more defensive in our portfolios, anticipating this type of drop, as Lance mentioned. And our investment committee is going to be looking pretty hard at buying more equity. And I took a look at some of the valuation metrics we pay close attention to, and those are starting to look more attractive and getting close to the point where we want to put more money into the stock market. So you can watch for communication from us, but we see these market drops as opportunities, and it should be really a great opportunity to buy stock at a cheap price. And once the market recovers, everyone will benefit. So we will keep the communication open, and every Friday we are planning on sending out an update, and continue to watch those updates every Friday, and we'll keep you posted on what we're doing with your portfolios.
Yeah,
Go ahead, Lance.
yeah, Jason, thank you for that. We did actually have several questions on when to think about buying additional stock or increasing that stock exposure. I really like that our clients are thinking ahead like that, when to take advantage of potential mispricings in the stock market. We have had some additional questions come through. Real quick, to clarify regarding rebalancing, we do that quarterly. The next one will come at the very early part of April. So we're about 2.5 weeks away from that rebalancing period. Jason, if I can maybe send another question your way. This one relates to comparing what's likely to be a recession with prior recessions, maybe in particular the recession that we had in 2007, 2008. What are some similarities or dissimilarities?
Yeah, it's a really good question. And from an economic standpoint, there's definitely a lot of differences, I would say. And this time around, really, what has been the case is that there's really been some supply issues, and people really kept the demand up this time around, but then we had a supply issue of not being able to get people the goods that they wanted to buy. And that differs from most recessions, like 2008, when it's usually a demand side recession where people are unemployed and they just don't have the money or the demand to buy goods. So hopefully we can hope that this passes quickly and we don't see unemployment spike, and then we'll have a demand side recession again. But from the market standpoint, we saw the market drop faster than any bear market in history. And so what I can say is more than likely we're going to see a recovery faster than we've seen in the past. That's what we can hope. And that, of course, depends on what happens with this virus. Very unpredictable at this point. But what I would say is we've seen a quick drop, and just be careful. We want to stay invested because we're going to likely see a quick recovery as well. We can hope.
Jason, could you also address, how do we make changes, or how do we notify clients of potential changes as the investment landscape, changes day to day, month to month? Maybe if you can go into just a little bit of background as to how we make those decisions as a team, and then how we disseminate the information out to clients.
Sure. Our investment team has a scheduled meeting every month. Now, in situations like this, we could meet more frequently than that. And we get together and we discuss, the current economic environment and the current market environment. And as we make these decisions on what to do with the portfolios, We generally send our communication out by email, and so you can expect to receive those email messages. And then when appropriate, we will also make phone calls as well. But what we really try to stay transparent about what we are doing and what we are thinking. And our investment committee also tries to be very proactive as well through all of this.
Yeah, great. Had some more questions related to the effect of the stimulus. Assuming we have a stimulus plan that's agreed to, what the effect may be on the economy and the markets. I can throw in my opinion, and Jason, maybe you can be thinking if you have anything to add. I think the stimulus as it looks now will be helpful, especially since it's directed towards individuals and small businesses. So it'll pump money into an economy that will desperately need it, especially for people who aren't able to meet their monthly bills. That should be helpful. However, there will be a certain amount of economic activity that we can't get back. So I'm thinking of events. The NCAA tournament is a simple example that was canceled. There's a lot of economic activity surrounding that. We won't be able to get that back. Many conferences and conventions are being canceled. There is a tech conference that's held annually in Barcelona, and it's likely not on many people's radars, but that one tech conference generates about $500 million in activity. So again, that's activity that will be lost and that we won't be able to get back. So maybe that's a long way of answering the question. I think the stimulus will be helpful, but we can't get everything back. I would also add that if I had the ear of any government official, I would suggest restructuring their debt, retiring some of the older debt that's at higher interest rates, and refinancing it at today's rates. I think the last I looked, the 10-year U.S. Treasury bond was trading at 0.7%. If the government can borrow at 0.7%, I'd be retiring all of the old debt I could and locking in those lower interest rates. Jason, would you add anything to that?
Yeah, I think those are good points. Also, it'd be a good time for our clients to maybe look at refinancing debt as well, particularly with mortgages. But and what we've seen so far as monetary policy and the Federal Reserve stepping in, it's likely going to give a little boost to the markets. At this point, the Federal Reserve, more than anything, will probably stabilize some asset classes. They've done this quantitative easing, which is essentially just buying different types of assets, and they provide important liquidity where liquidity has dried up, where nobody else wants to buy those assets. The Federal Reserve steps in to do so. So it's an important role, but further Federal Reserve actions are probably not likely to boost the stock market much. It will be dependent on those fiscal actions by the federal government. And, it is tough to say, but the $1 trillion package that they're talking about should certainly boost the market, should certainly help the economy as a whole.
Great, thank you. Just trying to sort through some other questions that have come in. Jason, I'm putting you on the spot again. Is there a certain point where if the market falls below that, it doesn't make sense to stay in any longer and we would consider having our clients sell out? Just a sec, I'll unmute your mic there.
There we go. The short answer to that is no. We would never leave the market entirely. And it's really the worst thing you can do. If you leave the market, you're almost guaranteed to also miss out on the recovery because it happens so quickly. That chart that Lance showed, it's easy to say, well, a lot of people have told me this. They'll say, I'd rather be on the sidelines, and then when the market starts going up, I'll put my cash in then. The problem is there's a lot of false really starts to a bull market. And we could see the market go up 1 or 2 days in a row. And so people think, oh, now's the time to go in, but it'll fall right back down. So the short answer to that is no. Every single time in history through the barest of markets that we've had, the market has recovered to new highs. And so again, we would never get out of the market entirely. We would only use it as an opportunity to buy stocks at a very cheap price.
Yeah, and I would maybe add that the reason we can be comfortable with that answer is that your team has worked with you from the beginning of your plan to create an investment allocation that's appropriate for your situation, that meets your tolerance for risk, and can also meet whatever objectives you have. We would maybe have a different answer if you were in an allocation that was far more aggressive than your situation warranted. A couple of questions regarding the frequency of rebalancing. Our team would consider doing that more frequently than quarterly if we continue to see volatility as substantial as we've seen. Since we have a rebalance coming up here shortly, we're going to stick to that schedule. But if volatility continues, our team will talk about doing it more frequently. Now, on the right-hand side of your screen under the group chat, I've dropped in my email address. And if you have further questions, of course, you can direct them to your team, of course. You're welcome to contact me. I'd also appreciate your comments as to what you liked or didn't like about this format. This is a new system that we're using. We're all kind of dealing with a situation that we're unused to, so we pulled this together kind of last minute. We may look at continuing to do something like this if the situation warrants it. Maybe a few more questions here since we do have the time. Jason, once again, I'll kick this over to you. For those individuals who are in retirement, don't have an ongoing incoming paycheck, is now the time to buy more stocks since prices are lower? And maybe this applies to all individuals.
Yeah, overall, I would really stress just to stick with the overall investment plan. And so, if we've put you into a specific strategy, such as a moderate portfolio or a conservative portfolio, really stick with that strategy. And the nice thing with those is we built in some flexibility so our investment committee can buy some more stocks for you if the situation warrants. But overall, it's stick with the plan and don't deviate outside of that. And as far as people taking distributions, we may have touched on this already before, but part of your financial plan is that we want 3 to 5 years worth of your distributions in bonds. And so if the stock market continues to drop and you need money for those distributions, we'll generate that cash from the bond portion of your portfolio. So we don't need to sell stocks when they're at a low price. We'll let the stocks recover in value. So overall, stick with the financial plan, and your financial advisors will know what to do.
Okay, and with that, I think we'll wrap up our session for today. Thanks for spending your time at home with us. We thank you to our clients. We thank you for entrusting us with your resources, doing the best we can for you. If you have questions, you can reach out to me personally or get in touch with your team. Even though we're all working from home, we're still readily available to help you out. So thank you, and please enjoy the rest of your afternoon.